What's up, guys? Today we got Devin, one of the co-founders over at Gammaswap. This project is basically seeking to maximize yields on LPs, turn impermanent loss into impermanent gain, and create a perps marketplace around LP tokens in DeFi. Before we get into the details on this project, Devin, tell us a little bit about yourself and why Gammaswap.
Yeah, thanks for having me on, Drake. I've actually watched some of your videos like a year and a half ago, so it's really cool to be on the channel here. A little bit about myself. Yeah, I've been involved with crypto since 2016. Started out doing some arbitrage and centralized exchanges. Just thought Ethereum was really cool, how you could basically program, uh, yeah, anything basically, and it's not owned by like one company or entity, and it's just out there for anyone to interact with. And then yeah, when I graduated, there wasn't much work in Web3, so worked in Web2 for a while. Worked for a few software startups. One was a YC company doing like software billing management. Another was helping other companies manage software spending usage. That one got acquired. And then went full tilt into crypto for about a year, just trading. Had some ideas I wanted to work on. And then most recently, I was at Figment. They do a lot of the proof of stake infrastructure for basically validators. So it's helping out with institutional partnerships and developer relations. And that's where I actually met the Gammaswap guys in May. I was helping judge a hackathon at the time, Activate X Wormhole. And yeah, I heard about Gammaswap and I was like, this is really cool. I had been LPing for a while and kind of stopped just because, yeah, the yields weren't what they used to be. And really only would do it if it was like a new chain or a new project that was offering like good incentives. And so, hedging that made a lot of sense. And then kind of when I figured out like the long-term potential of helping scale DeFi and maybe even creating like a new type of AMM, I just thought it was too interesting, not to work on. So joined the team full time shortly after that.
Yeah, it doesn't take anyone long to realize the value of proposition of Gamma Swap without just, I mean, all you got to do is provide liquidity for about a week, 2 weeks, and you're like, what happened to all my money? The
Yeah.
impermanent loss is crazy. I deposited in here and I had so much more, but it is what it is. So on a, I guess you can say, explain it like your five level. What is the concept behind your protocol and what problem is it actually aiming to solve in DeFi?
Well, there's lots of areas where this could go, but the easiest way to think about it is just shorting liquidity in AMM. So, if providing liquidity is not positive expected value, it's negative. And if you short it, it should be a positive expected value trade because then you can profit off that impermanent loss. So that's essentially what Gamma Swap in the simplest form is. It's a way to borrow that liquidity out and take the opposite position. And can work with any AMM or any LP pool. But what we're really hoping is that we can help LPs basically be passive and still expect to come out positive EV. And the reason we think we could do that if the model works is that if you look at like traditional finance, the edge has been the volatility sellers generally when writing options. So um, there's this thing called implied volatility, which is basically what the options positions are implying the volatility is, or like basically the demand for that volatility and the actual realized historical volatility. And since 1990, 83% of the days in traditional options, IV has overstated HV, meaning the demand for volatility was higher than it should have been. And so the edge has been the volatility sellers. And the reason it hasn't really been like that in AMMs is because, it's like a one-sided market. I I don't know how much people are familiar with like the whole GMX situation here, but it's like, yeah, if you had a stock and you didn't allow people to buy it and only sell it, of course the price is not going to reflect the fair value and become really depressed. And I think that's what we're having in AMMs now. People can sell volatility by providing liquidity, they can market make, but no one can take the opposite position to short that. And so there's no real pricing of the implied volatility there. Just you either can provide liquidity, which lowers implied volatility, or you can withdraw it. But there's no one like UniV3, I guess. You can withdraw it by not having as active liquidity, but there's a lot of complications there. So this is something that can work with UniV3, but basically another way. Basically, you have speculators or like option traders or people wanting to hedge that will withdraw that liquidity for LPs. So it's a way for them to be more passive and still basically get better risk-adjusted returns for the type of market making they're doing.
Yeah, it was an interesting comment you made about GMX. I'm kind of curious what would happen if people were able to. Well, I mean, that's also why I'm interested in Gammaswap is when people are able to bet on volatility. Because right now, the only thing you can, well, go long volatility. Right now, the only thing you can do is go short, and that's by being an LP. Or, I mean, I guess you can hold the token, but that's not being long volatility. Because I mean, you have
Yeah,
an infinite upside, but you can also just go to zero. So it's like, wait, you can only profit 50% of the time. But with volatility, being able to take that straddle position, you can win if it goes up and you can win if it goes down. And that's also
yeah,
why I like Dopex, how they offer straddles and whatnot. I mean, sure, you take on that risk where it doesn't go up or it doesn't go down and it stays in the middle. But I mean, being able to do that on extremely volatile tokens, like, I don't know, not sushi, but like another yield farming coin, that'd be crazy. It's a no brainer.
for sure. Yeah, I think because that's in traditional finance, which there's obviously volatility, but I think crypto is even more volatile. So I think you might even see it be more biased to like the IV overstating the historical volatility even more in something like this, where LPs can come out, substantially ahead maybe of like option writers in traditional finance. So that's kind of what we're hoping for. And then yeah, this is just I think perpetual futures is the way you can long volatility right now, and I think they're great products, and I don't think they're necessarily competitive. So this would just be like a new type of options product. I think with something like GMX, you could probably get more leverage and less slippage. And then something like us, basically, you're not required on Oracle, so you could basically get this leverage kind of like exposure to any token. And then it's also different than a future in the sense that so you could do in our new UI, you can do basically choose a call, put, or straddle, and which token you want to provide in the pair as collateral, like ETH or USDC, and the maximum LTV could be like 97%. So you basically can get a position 33x your margin. Um, but the types of options are super different because with the call, for example, since the delta in AMM is changing, unlike a perp where the delta stays the same, basically you can get more leverage as the price moves away from you. So like for an altcoin, if we're to move like 200% in a couple weeks, which like
Okay.
really long tail altcoins do often in the bull market, you could get like 20, 30x leverage on that, but that in a call form. And then if the price moved against you 100%, not only would you not get like liquidated because there's no liquidation price, you'd be in profit of 10%. And as you're mentioning, it's that middle area where there's no volatility that you could get liquidated because there is an interest rate you have to pay to the LPs to borrow that liquidity. And so it's a formula based on the fees that LP position would have accrued plus the utilization of the pool. And so yeah, that's where you can get liquidated depending on the utilization. So maybe in altcoin, maybe there's a lot of people wanting to long volatility, but I think in normal situations, you could have like a 97% LTV position and hold that position for 2 to 4 weeks without having to like top up your collateral. So that's a good amount of time where there could, especially in like a bull market, like there could be a lot of volatility. You could prop up with that.
Yeah, and I don't really see a concern for getting liquidity because this is just a way for liquidity providers to maximize their gains even more. I mean, if they're already providing liquidity, I mean, now they can deposit on Gammaswap and just get an additional yield. So it's kind of a no-brainer. Um,
Yeah.
but what about like, say for example, on Sushi Swap, if I'm providing ETH and Sushi and depositing into their Sushi pool, will Gammaswap enable a pool that allows me to deposit these already deposited tokens on Sushi? That way I can still earn the Sushi token as well as earn additional yields from Gammaswap?
Yeah. So it depends on the AMM and the
Okay.
project. So some of these AMMs we're working with to put part of their emissions to us. It's probably not going to be the same as theirs. Um, Well, it depends. Some AMMs, will just accept our LP tokens, and then it'll be the same for every pool. And then some, it depends how the staking contracts are set up essentially. Some would have to provide it to basically our LP tokens like separately, and then some don't even accept other LP tokens in their gauges, and there's no way to actually have those emissions go out. So it really depends on the AMM. And then what I think we'll see if Gammaswap is able to attract liquidity and the model works is that new projects maybe will provide some of their incentives to like an underlying pool, like a sushi, a balancer, and then
Mhm.
some to our wrap pool. Or hopefully like less projects will have to offer these super inflationary token incentives. Like where I think Gammaswap adds the most value is that those long tail assets because you know maybe something like ETH, BTC, where they're kind of large cap. There's a good correlation not only between the two tokens of that pair, but between the actual volatility and volume. So maybe you're not as badly compensated for the risk that you're taking. But then if you think about like a new project where it's super volatile, acting like a penny stock, but there isn't much volume yet because not many people know about it. It's really hard to be an LP. There's no way to hedge your insurance. You can't buy a perp or borrow against your position because that token's not supported by an Oracle yet.
Right.
And also those, aren't necessarily the best hedging solutions because the delta is one. So if the price moves a lot, you're gonna have to constantly rebalance versus maybe a hedging strategy in Gammaswap, but no way to hedge at all. And so this would be a way not only to like if I'm basically, I'm an investor, I like a project, but I realize there's a lot of volatility risks and yeah, maybe, I'm not sure about the tokenomics or yeah, the model hasn't proven itself. Like I'm bullish, but I want to hedge my risks and I can't. And so a lot of LPs, maybe aren't willing to provide liquidity. And then even if they are, they're getting really hurt by impermanent loss and not being compensated well by the fees. So I think particularly for those long tail assets, this is something that would better compensate the LPs and give them a way to hedge. And we may even see, hopefully, like maybe new projects, they'll actually, instead of launching, well, they'll have to launch a pool, but maybe they provide token incentives to a vault that's like already hedging for their LPs, for example. Like that could be what projects maybe decide to do in the future. So I think there's a lot of ways that this could go, but I think particularly for that long tail, that's where we see this biggest discrepancy between volatility and volume, and that's really where Gammaswap can help some of these pools and these LPs scale better, compensate those LPs better for the risk that they're taking.
Yeah, that would be interesting because that would be kind of a form of a sustainable yield because you're having different people pay into these pools or pay for the service they're getting, which they're being able to hedge their position. Because normally the issue with a lot of these farms, like say for example sushi, how do they incentivize liquidity? Well, they pay out the sushi token. Well, that's technically being a pool too, and you're diluting the person. So even though you're
Right.
paying them for it, it's either they dump the token and further create more impermanent loss into the pool, or they simply just hold it. And at that point, everyone's just getting diluted in that position. So I think a lot of these new projects that are unable to afford providing liquidity by just like incentivizing with a food farm token, or B, who want to create a sustainable token price by not just diluting it. I think Gammaswap can come in and help with that, and I think that would be pretty interesting.
Yeah.
The biggest question I do have is the how to determine the utilization fees as well as the funding rates. How are you going? Like, let me give you an example. On Aave, they aim to have like 80% collateral, not collateral, but 80% utilization. So what that means is like, let's say there's $100,000 in ETH and there's $80,000 borrowed of ETH. That would be an 80% utilization. The reason why
Yeah.
they don't want 100% is because no one can withdraw. So what they do is they have like a set rate. It's basically a scale that runs like this. And then once it hits 80%, it just starts to ramp up. And the closer it gets to 100, it basically goes vertical.
Yeah. So good question. We have a formula that's similar to Aave, but something tailored for the unique aspects of our platform. So it's something that's more um, quadratic, like more exponential than AMA curve. So basically, we're aiming to have about 50 to 70% utilization, not of the total AMM, but of the liquidity in Gammaswap. And then after that, it starts going exponential where the interest rate is increasing a lot to not prevent, like all the liquidity being withdrawn from the pool. So there's, not like, because that could cause a lot of volatility on
Yeah.
the tokens, of course. So that's how we're doing it. The exact formula, I'm not the most quantitative on the team, so it's not my creation, but basically we are synthetically tracking the LP fees, and then it's a combination of that plus kind of like a utilization curve similar to Aave but more exponential. So it's that combination, and then as we get to those points of utilization, like 50 to 70% above, that's when the interest rate is going exponentially. But at the same time, there's also other things we're taking into account. For example, to enable some accurate pricing, like after about 50%, we start discounting the LP fees, for example, because at that point, at that much liquidity withdrawn from the pool, the LP fees aren't what they originally were.
Right.
Because there's not as much volume. There's more, I guess, to each LP. It depends, I think, on the relationship between liquidity in the pool and volume. But that's something, for example, that we're taking into account as well. And there are a few other factors that are included in that formula. But I would say, in the most kind of like general sense, it's something like Aave, but more exponential.
So are pools going to be whitelisted? Just a quick question, because
So
I know, like for example, Uniswap is not whitelisted. Anyone can make
yeah,
a pool.
so that's something we've been thinking about. So we will be permissionless. The first month it'll probably be permissioned with some larger cap pools,
Okay.
just so we can see how our interest rate model actually performs with real money. We've done some back testing, but back testing can only be so helpful. So we just want to see how it performs. And then something else we've been thinking about is it probably is not for like a V1 of Gammaswap, like a V2 or V3. Not every token should have the same curve, for
Right.
example, because it really depends on, how new the project is, market cap, token supply probably should also be considered as well. The problem is we don't want to overcomplicate the ability to add a pool, but we were thinking, enabling people to add pools and like change the interest rate
Right.
and having visibility into that. Once again, I don't know if that's exactly the best path, but essentially having variation between the types of interest rate curves, because it shouldn't necessarily, I don't think the best implementation will have the exact same curve for each pool.
Makes sense. Makes sense. So I guess from just explaining it, can you talk us through the process of using the protocol and onboarding opening positions? So like, what is the step-by-step process that you can explain?
Onboarding a position. Yeah, I guess it
So
depends
like
if
if I
you're
wanted to like say for example I'm providing liquidity, what would I do? Like, hey, I got some LP tokens, Gamma swaps here. What do I do?
Yeah, so if you have let's say you're depositing into ETH USDC in SushiSwap, and you have those Sushi LP tokens, you can deposit those in Gammaswap. Or maybe if you want to deposit into that pool through Gammaswap, then you can also deposit the ETH in USDC. And so that whole kind of like earn AMM section is going to look a lot like a traditional AMM, except there's going to be a few different AMMs, so you might see the same pools across AMMs. And then you have that option to deposit either LPs or the underlying tokens.
Okay.
And then on the opposite side, you have people that are longing volatility. And I think what we realized from our testnet is that although it was really cool to give people the flexibility of changing their collateral so they can get their own kind of like impermanent gain curve.
Yeah.
I think it's if you're not super quantitative or you're just learning about the protocol, it could be a little intimidating and hard to use. And so what we're going to do is we're going to have something that looks a lot more like a perp, where essentially you pick a call, a put, or a straddle, and then the token you want to deposit in. You can do both or one, and that'll change your curve essentially. And then we'll tell you which one or both to deposit. you deposit that, basically change your LTV. So it's something like 90%. You can hold your position for a long time, but you get less leverage and are less capital efficient. And then all the way to 97, you have a lot of the max leverage. You have the maximum capital efficiency, but you might need to monitor your position more actively, especially on like an altcoin, for example. So that's what the new UI is going to look like. I think we're already kind of a difficult protocol in some ways to understand. So we want to make sure the interface is as familiar as possible. And I think although we're not exactly like a perpetual future, it's like a perpetual type of option. So we
Right.
wanted to make that experience familiar to people who trade perpetuals in DeFi.
So I understood because I was playing around with it yesterday and the day before. I in the thread I was putting together on Twitter, and when you deposit those tokens into that pool, or I'm sorry, not deposit, when you borrow those LP tokens, effectively you're shorting the LP, which basically means you're longing volatility. In order to practice that long position, even though you deposited collateral, let's say in some ETH and maybe some Uni tokens, if you're doing ETH and Uni, would you have to open that short by unbonding those LP tokens, or would you
Yeah,
just leave them?
that's exactly what we're doing. Yeah. So
Okay, okay,
essentially what we do is if you're borrowing liquidity, whether you're doing it through ETH, Uni, or both ETH and Uni, the collateral is just to make sure the loan's over collateralized.
right,
But what we're actually doing is we basically, based on your LTV, it's worth a certain amount of LP tokens. We redeem those LP tokens for the underlying, and then we keep all the collateral on the underlying tokens in our platform. So you won't be able to loop, for example, but that's how we basically make sure you're over collateralized. And then
okay,
if there's any volatility, basically those underlying tokens are worth more LP tokens. That's how we turn impermanent loss into impermanent gain.
right,
When you deposit one token and weight it that way, you get things that, for example, the more volatile tokens. So if you deposit more ETH, you'd probably get something that looks more like a call, and then Uni something that looks more like a put. But with that pair, there might be a little bit less volatility. So there's, I think, different things to factor in. Volatility is good, but if you have a super volatile pair, then maybe that interest rate's super high. So, maybe if you, yeah, for like ETH Uni, you think one's going to change from the other, and then you'd
yeah.
prefer to do the ETH and Uni instead of the ETH USDC because that interest rate's smaller. So there's a lot of things maybe that would end up being considered into that, but that's how we're doing it. I think the important thing to keep in mind is that the LPs in our platform aren't the counterparty. It's actually all the liquidity in the AMM. So the LPs in our platform should always be better off than like the vanilla LP position, except as you mentioned, if there's a lot of token incentives being applied to the underlying pool, that may be, and the utilization on our platform isn't that high, that may be a reason not to provide liquidity in Gammaswap because yeah, that yield in Sushi might be higher. But without token incentives, it should be that the yield in our platform is always greater or equal to, depending on the utilization in the underlying pool.
Yeah, and obviously with the LP position, depending on the collateral you provide, you can take directionality by providing more of that particular collateral. So, for example, if I'm bullish on ETH, most of my collateral would be positioned in ETH instead of something like a stable coin or whatever the other token is. Yeah, that's interesting.
Yeah.
Okay. So I
And
guess
then if
for
you
the go ahead.
Yeah, another thing that is interesting to think about too is if you use borrowed funds, then you don't actually have exposure to the underlying assets or what you provide
Yeah.
as collateral. You have the extra interest rate, but then you're only trading the impermanent loss for like whether you're long it or short it, depending on whether you're an LP or long gamma. So that's another way. If you want to just be purely long volatility and have no exposure to the collateral, you could do it that way.
Yeah, and I guess another way is if you wanted to take directionality as well, you can borrow those tokens, the LP
Mhm.
tokens, if effectively you wanted to short them, just sell them into a stable coin and then just buy them back cheaper for the LP. Does that make sense?
You would borrow the LP, so you would long volatility and then sell it into stable.
Yeah, so if you're long volatility, what you would do, let's say, for example, obviously like shorting one of the assets. So let's say
Okay.
the token pair is ETH and Sushi token, and I would provide the collateral of just straight ETH. Let's say I want to just do 100% ETH because I'm super bullish ETH. I would borrow
Mhm.
these LP tokens with Sushi and ETH, and because they're the LP token, I would then take these LP tokens, unbond them, and now I have two separate tokens, which are ETH and Sushi. I can sell the
Mhm.
Sushi into ETH or some stable coins. Does that make sense?
Yeah, so yeah, that's what I was saying about the collateral being locked. So you wouldn't be able to withdraw the collateral when you open the long gamma position or shorting that liquidity. So you wouldn't be able to do that because that's how we get around not using the Oracle and making
Mm-hmm.
sure the loans are over collateralized. So it's a little bit different than something like Aave where you could like loop and do that. All the
Okay. Okay.
collaterals locked in our platform. Yeah, that'd be cool though. If that was possible, but that's maybe in like a future version if we find a way to do that. But right now this is the simplest way to make sure all those loans are over collateralized.
Okay. That makes sense. That makes sense. All right. So, can you discuss the current state and the future plans of the protocol, like upcoming partnerships, upcoming features, etc.?
Yeah, current state, last week of audit with Halburn. So our core smart contracts are being audited. We also we just received a grant from Balancer and we'll be doing a Balancer implementation. So we're basically at the tail end of doing that. We're just unit testing everything, and then that will get audited. It's only a few hundred lines of extra code, so just a week to get audited. And so we should be ready for our mainnet launch on UniV2 Sushi and Bouncer end of this month, earliest March. And we'll probably have a beta testnet before that with the new UI. So yeah, the two things we're working on right now is the Bouncer implementation, the new UI for the barway to be more like a perp. And then after that, I mean, there's a lot we want to launch. So we just I'm not sure if it's been accepted, but it's the last day and we're almost at 99% in favor for it, but we did a GMX swap proposal
Yeah, I saw that.
to build some vaults on UniV3, yeah, and then some structured products. So that's probably something we'll be doing after our UniV3 integration. So it'd be UniV2, Sushi Bouncer, then UniV3, then these vaults, and structured products, and then there's a lot of other products we want to build if this model works. I don't want to give it away because we haven't exactly thought through the implementation, but if the model works, I think we want to touch every category in DeFi with a new type of product. Um, so yeah, and then we also have a new AMM that we want to launch that would actually be a fee list X. So um, I don't think it's going to necessarily like compete with Uniswap, but it would be like a new type of AMM where it's not incentivized by swap fees at all, and instead it's just purely by the people trading volatility. So I know a lot of people think
Interesting.
about impermanent loss as bad and us as like uh, taking away impermanent loss, which I think we're providing a way to hedge it and compensate LPs better. But there's no free launch, so there has to be risk somewhere. And
Yeah.
so counterintuitively, on our new AMM, we're actually going to increase the impermanent loss because then on the opposite side, someone could basically get an option on any token with 100x leverage. And we think actually, once again, counterintuitively, uh, increasing the impermanent loss would actually increase the APY for LPs because people can get so much leverage on the opposite side.
Right.
If you think about like GMX, you're getting 50x leverage with no slippage, and with GLP, you have kind of this passive, LP product that is, typical of market making and TradeFi. Not always profitable, but on average, profitable. And
Right.
so that's kind of our theory with this new AMM as well. And then, yeah, it would have this feeless DEX. People have asked us why we would even have a DEX connected to it. And the reason is it actually helps price the volatility positions better because it basically would reset the APY and the cost of buying those positions. So it's basically the pricing engine. The swaps would be the pricing engine of this AMM. And I think if we were connected to a liquidity aggregator, we'd kind of be like a Robinhood or commission-free exchange where we'd get those smaller size trades where commissions eat up more of the profit. But then like a high size trade where like slippage matters more, that might be routed to something like UniV3, similar to like a dark pool and TradeFi where you pay the fees, but you get better execution on that trade. Right. So I think it's just gonna kind of be a new product, and then give, I think all these kind of like incremental innovations in various areas of DeFi is how DeFi can become more competitive with CeFi. So I think the way we think we can help is by helping be kind of like this modular scaling layer for AMMs where LPs can be a little bit better compensated, and then hopefully we see TBL and DeFi increase, and then this new type of DEX product which may attract more retail traders into DeFi because they have to kind of like similar to Robinhood, even if it's not the best execution, they get low fees, and that's very attractive to smaller size traders because they benefit from that the most.
Yeah, no, that would be interesting. I'm definitely looking forward to that. So on Gammaswap, what are some of the risks as a trader or an LP, well, the liquidity token provider, encounter using Gammaswap?
As an LP, it's the same risk as an AMM. Like we have parameters on the long gamma side. I think that's where things get a little bit more complex, but AMM, someone could control the liquidity, withdraw it, like mint a bunch of new tokens. So you should always look at the smart contracts of the tokens you deposit into. The thing about Gammaswap is, of course, we have the extra smart contract risk since it's now, the underlying AMM smart contract in ours. But from an economic perspective, it shouldn't be more risk to provide liquidity because all that liquidity in the AMM is a counterparty. So you'll earn all that yield from the underlying AMM plus the borrow fees, which are dynamic. And the cool thing as an LP is that even if you're not hedging, you can almost think of yourself as pseudo hedge because you can imagine that in periods of higher IL, there's periods of higher volatility, so you're earning more borrow fees. In the periods of lower IL, we'd expect you earn less borrow fees. So that way you're kind of hedged.
So what about the problem with bad debt? Like for example, recently we saw Aave and Curve. Curve was exploited, not Curve the protocol, but like Curve was used to exploit Aave by manipulating the price, and there's low liquidity on there.
Right.
Is there chances of bad debt on the protocol? Like let's say for example, 100% of all the LP tokens are straight on Gammaswap, and people are speculating on it. In order to liquidate that, where's the liquidity to liquidate it?
Yeah, I'll explain why I don't think there's bad debt scenarios, but there could be like there are other potential black swan scenarios that we're mitigating with parameters in our platform. So I'll explain those two things. So the reason I don't think we'll be in bad debt is because we don't actually rely on the price of any asset for our loans. We're just using liquidity invariant, and liquidity invariant isn't the price of the assets doesn't affect liquidity invariant at all. That's how we get around using an Oracle. So there was actually one platform that was doing what we were doing. Sushi created it. It was called Akashi Network, and so the design flaw was that they were using like the actual like tokens as collateral, or the LP tokens, and those have price variation. So that's why we've chosen to use liquidity invariant. Now, so that means that all the loans, all the long gamma positions are always over collateralized to provide that collateral, and then you have that collateral which over collateralizes it. And then if let's say you're in a situation where you get liquidated, right? That's because there's no volatility, and that interest rate ate up all your collateral. So we'll need like liquidators, keepers to do that. But as long as they have the incentives to liquidate, we shouldn't have bad debt from that. And then if there's any volatility, there's no delta risk in our platform. So if there's any volatility, those loans actually become more over collateralized because the position is now greater. There is the potential where on the long gamma side, there's a really big position and someone wants to liquidate them. If they were to own all liquidity in the pool, they could essentially withdraw that or just basically make the APY really high. And so we have parameters set in our platform to control for that. So the cap basically in terms of the interest rate changing is at 1,000% APY. And even with a 97% LTV ratio and 1,000% APY in the underlying pool, which isn't including token incentives, so it would be a really crazy scenario, but it could happen. It would still take about 24 hours to get liquidated, which we think, because of that really high APY, incentivizes other people to come provide liquidity,
Right.
or that long gamma option trader to top up their collateral. Now, someone could say, okay, this could happen in like some crazy altcoin. Someone creates this random project and this happens, and no one wants to provide liquidity. Well, yeah, I mean, I think there's risks to AMMs. So you always have to make sure that you read the smart contract and understand the project. And yeah, if it's not a completely decentralized project, maybe you don't want to basically open like $1 million positions on the other side, but we have these parameters set in place to basically reduce the chance of someone getting manipulated. But yeah, I think it's similar risks to AMMs where someone could withdraw liquidity, someone could rug the project, maybe they have some malicious code in their smart contract. So I think people have to pay attention to that. But there shouldn't be a bad debt scenario. And there are these risks that maybe someone would try to liquidate someone on the long gamma side. And so we've done our best to mitigate it without necessarily handicapping the ability of people to open these long gamma positions on any token.
Right.
So we think this is like a good compromise because yeah, you should just be careful, especially if you're gonna long volatility on like a new project. But yeah, the code is audited and that you've had a chance to look at the code too and make sure that that person isn't going to do something with liquidity which could hurt you. But in normal scenarios, I think you'll still be fine through Gammaswap.
Right. Okay, that makes sense. Okay, so I guess now let's get into the gamma token. Well, is there a token? Or
There's a token, yeah.
okay,
GS token.
airdrop, right?
Yeah. No comment.
Yeah, no comment. So can you discuss the protocol's governance model and how this would be implemented and basically the decision-making process around it? Like what is the if you can say the token utility?
Yeah, unfortunately, there's only so much information I can give. I'll explain why. I'll say this. We do plan on having a token. It's primarily going to be distributed through liquidity mining, and then we're also going to be a part of the real yield narrative, just because we think that's a better way to do tokenomics. And yeah, we want to reward our holders and scale Gammaswap to be something great. So there will be part real yield there. Now, we were going to do a tokenomics model very similar to GMX initially. We had an idea for something completely different that basically solved a couple of problems we were thinking about, like market making and providing liquidity, but also giving people the optionality of not being locked in. So we have a new tokenomics model that we've been thinking through, and we need to get it audited. So we were going to launch the token immediately on mainnet. Now it's going to be about a month after.
Okay.
But so I can't tell exactly what that is, but I'll say that it's going to be part of the real yield narrative, and I think it's going to be a new innovation, and I hope. Well, I think it depends on the type of product you are, but I think it could be used by other protocols as well to solve those two problems I was mentioning, like market making and providing kind of like getting deeper liquidity, like providing liquidity incentives without maybe forcing someone to lock their token for like 5 years. So that's what we're working on right now. But yeah,
Okay,
we'll have
so
a
we only
token
have to lock it 4 years now, right?
Exactly.
Interesting. Yeah, because there was a think it was Beethoven Finance. There's a couple of protocols that are actually doing a reverse governance model to where instead of incentivizing the people to lock up their tokens for like 4 or 5 years, a long time, and paying them like, for example, you go on Curve, the longer you lock, the more VE tokens you get. Instead, if
Right.
Beethoven Finance is doing this, I think it's I can't even think of the name. It starts with an R, Reliquary or something like that. Basically, where you the longer you stake your tokens, the more VE power you get. You probably I don't know if you played around with it on Terra Protocol or Terra Chain, Luna.
Yeah.
They had a protocol called Prism, basically just like incentivized APRs. And GMX has a similar model to where the longer you stake it, you get more multiplier points. It's the same concept. I don't know if you guys are hinting at something like that.
It's interesting. Yeah. I think we're probably gonna do some type of hybrid where
Okay.
you could lock, but it would be, I think, more like linear vesting. But then you also don't have to lock.
Right.
It's just there's incentives to lock. But I think, yeah, uh, be giving them people that flexibility and then having it linear. Because I think another problem maybe with like certain time periods, like a year, 2 years, 5 years, is well, everyone kind of could do it separately, but maybe a big whale does it for 5 years, or let's say a year. It's easier to think about. They do it for a year, and then everyone knows that, and then it becomes like some event. You know what I mean? Or it just drops. Maybe that person sells, and then that's a lot of volatility on the token. So I think in general in crypto, if you can avoid just kind of creating these artificial events,
Yeah.
around like big unlocks with vesting or token unlocks through like some type of uh, time locking model where it's more linear. I think just generally that's a better approach. So we're kind of leaning more towards something like that.
Got it. Makes sense. Makes sense. Okay, so I guess in developing Gammaswap and the protocol itself, uh, what are some of the challenges or obstacles you guys faced going through this, and how are you guys able to address them?
I think from a smart contract perspective, um, there were a lot of unique challenges with our protocol. We wanted to make it, completely Oracle free and permissionless, just so that it's usable on as many pools as possible. And then, yeah, we think that that also could help reduce attack vectors as well. So I think there's particular things thinking through that. And then if you're ever designing a new protocol, uh, there's new types of attack vectors or new types of manipulations. Every protocol could potentially be manipulated.
Hmm.
So just thinking through that, like these different scenarios of what could happen. We've been working. So our CEO's been working on the smart contracts since 2021. So we've had a lot of time to think about this, and we've chatted with a lot of smart people about the contracts as well, and they provided kind of good advice. So you might want to think about this scenario, like how would that affect your platform, or does that interest rate model that you're using like make sense for this? And so I think it's given us a lot of ideas. So yeah, we've been able to add some parameters to prevent these types of manipulations. And then also we have some ideas, in the future. I think it's kind of this hybrid approach. I think we wanna have the best implementation, but we also don't want to create too much friction for users. So I think there's really cool, unique things we can do with the interest rate, but like I mentioned, not adding that friction for creating a new pool. So I think if you're creating a new protocol, I guess with the smart contracts, because it's when you create them, it's going to be there forever until you launch a new version, and rightfully so. If there's a large type of manipulation that can lose trust with users, like spend a lot of time, talking to other people, thinking through the new like different scenarios that could happen, and making sure that your contracts, can basically persevere through those different situations. And it's not a lot of these things didn't come to us immediately, and came from conversations with other people. So I think oftentimes building in publicly or just getting uh, consultations from people in your network that could be helpful is super important. And then yeah, I think the go to market is just especially if a protocol is more complex and it's new, people probably aren't going to understand it. And so thinking about the ways to explain it and make it like easily accessible to people so they can
Yeah.
understand it. That's something that's been pretty hard for us, especially our CEO is very quantitative and came from a math background. So a lot of the first people we talked to, like potential partners, investors, thought we were going to be like this institutional product where only like funds would use us to hedge their LP exposure, and retail would never want to use us. And that was kind of different than the way we saw it. We thought, if we're successful, like funds will use us too, but we're mostly going to be a retail product. Um, and so I think that required us to think about that a little bit, like why do people think that? How can we make this more retail friendly? Not just, yeah, from the marketing perspective, but like the user experience. So um, that was something as well that we had to learn. So new innovations and complicated topics can be difficult. And so just, you know, I think lots of different like content forms. Some people are more visual learners. Some people, prefer reading versus like listening. And so putting the content out there and explaining, to different types of audiences in different ways so that as many people as possible can understand the protocols and for them.
Yeah, I think that's the biggest thing, is not, I mean, yeah, just dumbing down concepts and breaking it down and making it easier for people to understand. Um, the best way to gain market share or grow a protocol is create something with a clean UI or UX that's easy to understand and grasp. Like you go on GMX, you deposit in GLP, you have a breakdown of what you're getting when you get there. Makes sense. That's what the APR is. Oh, I get it. Like if the traders win, I lose. If I lose, or if the traders lose, I win. Okay, cool. Interesting concept. I understand it. It's the same thing on something like Uniswap. I understand I can deposit. Well, actually, Uniswap is a little more complex than something like PancakeSwap or SushiSwap. PancakeSwap gained a lot of traction and it's still extremely strong today because it's easy to use and people understand how to use it. And they even make it even more simple. Instead of having to take two different LP tokens, even though it may seem like it's easy to understand, for someone who's new to DeFi, they don't understand what they're doing. On PancakeSwap, you can literally just deposit one of the assets and it'll do it for you on the back end. And I see you guys are creating different vaults. So it's one thing to explain what's happening on the back end, but it's another for people who are like, oh, okay, that's a cool strategy. I want to deploy that, but that's too complicated. I don't want to click all those buttons. Oh, we got a vault. And you click on the vault, you make the deposit, you deploy the strategy, boom, done. And they're happy. They're like, this is great. Just like
Yeah,
GMX.
exactly.
Just like GMX. If I had to go buy Bitcoin, USDC, USDT, Frax, Ethereum, Uni token, Chainlink, and then go deposit in that pool, I'm done. I'm not doing that. I want to just deposit one token. Simple, easy, boom, done. So I think what you guys are doing is pretty sweet.
Yeah, I mean that goes with my general thesis of DeFi is that you'll have hedge funds and quants that will do this stuff on their own. But if we want to increase like the adoption of DeFi, we need to like abstract away the complexity, not necessarily decrease it, but abstract it away.
Yeah.
And I think that's something we're trying to do. Gammaswap. We realize we need to do that with the UI. We realize, even though LPs might be better off in our platform, some people are going to want to use us to hedge IL. They're not necessarily trying to get like volatility exposure. But managing that strategy is not an easy thing to do, and it's pretty active. Okay, we'll build these vaults for them to do it automatically, and then all these other products I think are kind of that light. It's not actually decreasing complexity. I think a lot of our products will actually be increasingly complex, but that complexity will be abstracted away. So like the user interface and interacting with those products will be hopefully pretty easy.
Yeah, that'll be key, especially for growth, but that'll be sweet. I'm looking forward to that. So, do you guys have any competitors? And if so, what are you guys doing to differentiate yourself from the rest?
Yeah, the only I'd say like competitor I think that we have, and they're not launched either, is Panoptic. But they have a totally different implementation. So I would say they're like actually building an options market on
Okay.
UniV3, and we're more building a way to borrow liquidity that gives you these option-like payouts. Yeah, and then other differences are that they're just on UniV3 and we're on different AMMs. So what is it like? What's the difference between option platform and what we're doing? Well, so for in our platform, the LPs are always better off than a vanilla LP position. But in something like Panoptic, you could write an option, but no one necessarily buys it. Now, the advantages of a protocol like Panoptic is that you can basically create an option. Like you have more optionality, create an option with any strike, uh, and that I think is really good for sophisticated traders. So I think we both have the same theory that LP tokens are basically like selling volatility, and our implementations are completely different. And so in that way, I don't really see them as a competitor either. I think they just have an implementation that's like a completely separate implementation with a similar thesis.
What are
Now,
some updates or items that are on the roadmap for you guys?
the AMMs that we're going to launch with initially are UniV2, Sushi, and Bouncer for a mainnet launch. UniV3 shortly after. We're going to build vaults for GMX in UniV3 as part of our token swap proposal. We
Okay.
also wanted to build basically synthetic calls and puts with them, where yeah, you have their features where you can get more leverage, but then if you combine that with like a Gammaswap straddle or even like a call or a put, then yeah, you have less delta risk. So you're less chance of liquidation if the price moves against you. So that's a cool structured product. There's vaults you want to build with, AMMs to hedge at IL. We can work with any AMMs. So we can work with like options AMMs or virtual AMMs as well to hedge some of that IL.
Mm-hmm.
And then yeah, I can't necessarily reveal all the products you want to release because I still think we want to think through the implementation. But I think we're we're gonna if it works well, we'll kind of you. I think you'll see Gammaswap become something like a Frax, where we're touching all these large categories in DeFi, but they all are part of our ecosystem. Like they would all be based off the Gammaswap protocol. Like just this,
Interesting.
yeah, like the volatility market. So it would be yeah, lending in these other categories based off yeah our ability to price volatility in AMMs.
Hmm. Yeah, that would be interesting. I'd definitely like to see that, almost setting a parameter. I know there's another protocol out there called IPOR. It's basically creating the base rate for different yields. Yeah,
Yeah,
that'd be interesting. Or well, different interest rates based on stable coins. So I think it'll be kind of
yeah.
interesting.
iPort is really cool. I think that's what you might see if Gamma Swap works out, is that there's like a lot of problems with maybe if you want to launch an options protocol and get liquidity, it's really hard. And then, it'll be people might be one-sided. They may have a lot of demand for based on your model. Maybe they want to buy a lot of volatility from you, or everyone wants to provide liquidity and no one wants to buy the options. Like every model is different, but like usually you see it like weighted to one side, and then
Yeah.
also yeah struggle to attract liquidity because yeah DeFi is still kind of new, and if you're a new protocol, it's kind of hard. So I think that's one thing we kind of solve for is we have like half the cold start problem. Like we still need to attract liquidity, but it's being composed from other AMMs. But then if you're an options protocol and you see all this liquidity in Gammaswap aggregated not only from multiple AMMs, but actually pricing implied volatility better, then if you're an options protocol, maybe you could use Gammaswap and build like something with expiries or some new type of like structured product, and you could just tap into the liquidity we have, and then you're not having to deal with as much with like liquidity issues or with mispricing of the options. So I think we could be this primitive for like other types of like options protocols or yeah, just new projects wanting to uh, bootstrap liquidity but not offer super inflationary tokenomics or token incentives to do it.
Definitely looking forward to what you guys are doing. This is going to be cool. I really like this protocol and this product for what you guys are creating. especially what is it, 2 years now, 3 years of basically just getting wrecked from impermanent loss. But yeah, no,
Yeah.
this will be cool, man. Devin, dude, it was great to have you on. Where can the audience learn more about the team and what you guys are doing?
Yeah, so I would say Twitter is probably the best way to stay up to date. Our Twitter handle is Gammaswap Labs. There's also a Discord link there, so we usually try to make announcements on Twitter and Discord.
Okay.
So that's the best way to stay in touch. And then yeah, we'll have our when we launch on mainnet, we'll have our website, which will have links like documentation, our blog, um, governance forums, things like that. So there'll be more kind of hubs to interact with Gammaswap, discuss Gammaswap. But right now, yeah, Twitter and Discord.
Sweet, sweet. I'll drop some links in the description below. And I always like to end all of my videos with a wisdom one-liner. So we're going to hit you guys with Proverbs chapter 10, verses 4. Lazy hands make for poverty, but diligent hands bring wealth. Be good, be righteous, don't be lazy. Peace, guys.